Hello, and welcome to this month's episode of Capital Markets View. Hello, Taron. How are you?
I'm doing well, Chris. How are you?
Good. I'm okay. I think, like most of the population, patiently sitting and waiting for that phone call to say, "Come and get your jab."
Yeah, we're all
um,
waiting.
yeah, and like normality is not far away now.
Hopefully.
um, yeah. Um, okay, right. So let's go to the first slide with some actual data on, which is European loan repricing volumes. Which I mean, and wow. Okay, so flat line, and then up it goes.
Yeah, I mean, it doesn't look that impressive. It's the bars are still low, but um, we will talk a bit about the U.S. because the U.S. is going gangbusters with its repricing. But we have seen a tick up in these, and I think last month we talked about the fact that we were anticipating this would happen. A lot more loans trading above par in the secondary market, pricing declining, and borrowers taking advantage of being able to reprice. So, still 3/4 of the single B credits in the LE, the European Leverage Loan Index, are quoted below par. So, um, there's not sort of a huge queue of them waiting, but we are seeing them coming, steadily.
You know what? In my inbox, and it's noticeable because it hasn't happened for a long, long time. Yesterday, I literally had 3 emails going repricing coming up, and that hasn't happened for a while, and therefore that's you can tell it's the beginning of a kind of snowball effect of things happening. But like you said, let's look at America on the next slide. US loan repricing volumes, because oh my goodness, whoa, look at that red bar! Wow.
Yeah, it was about $71 billion repriced in January, which was a lot. It was a good January for new issuance in both the U.S. and Europe. So it was about $56 billion in U.S. and about $14 billion in Europe. So it was actually the busiest month in terms of new issuance in both markets since January 2020. And if you cast your mind back to last January, it was actually a remarkable month in terms of the volumes that we saw. We were really, really busy on the data side, just trying to get all the deals into the database. So we've done really well in terms of new issuance, but there's still a lot of demand out there, which is why we're seeing these repricings.
Yeah, and I guess that shows in where we get to CLO volumes, which we'll talk about in a little while. But let's go to the next slide, which is average B-rated euro-denominated B spreads, and a quite marked downward sort of ski slope in that pricing, and clearly driven by what is becoming overwhelming demand for loan paper.
Yeah, and it looks like if you look at where spreads are for sort of strong single B credits, it's about Euribor plus 350, and the weaker names are sort of Euribor plus 400. So that's kind of where the repricings and the new deals are settling. So that's what we're seeing.
So I think last time we got together, we were talking about. I mean, I think we said pricing, settling at around 325, 350, and I mean, my goodness, it's already beginning to hit that, and we're only in February. I mean, I still stick by my prediction that it will be there, and then let's see what happens in the second half of the year. And of course, we'll talk about CLOs in a moment and where CLO pricing is going, which is obviously a key factor in where pricing is going, which is down. Okay, and let's pop on to the next slide, which is ratio of downward flexes. Now, I mean, for me, this is a new slide. I've never seen you do it in this way before, and I think it really illustrates. And again, I mean, so far, all the slides we've seen and all the trends, I mean, like ski jumps, like ski jump down, or the reverse of it going up. I mean, some really quite dramatic trends in literally the first 2 months of the year.
Yeah, this is showing rolling 3 months ratio of the downward flexes to upward flexes, and it's true. In January, we've just seen so many downward flexes. We were seeing that towards the end of last year, but this just shows you how quickly this is accelerating. And I think you're right. It's very CLO driven in Europe. The U.S. obviously had a really strong January. I think that's the next slide in terms of CLO issuance. But they also have had a lot of inflows into retail funds as well in the U.S., which we don't have here. But it has really been driven in Europe by CLOs and in the US by both.
Yeah, you know what? I read an article which was talking about how there's net inflows into loan funds for the first time in a long time, and partially perhaps as people are beginning to think about hedging against inflation, because of course loans are floating rate, and if policymakers use the traditional tool of raising interest rates to control inflation, then bingo, you've got a kind of inflation hedge. So yeah, it was really interesting to see that. But just look for a moment at the US figure this January versus the US figure last January. And don't forget, last January, the world was a very different place.
Mm-hmm.
And so we still haven't got through the pandemic, and their CLO volumes are massive compared with what was a normal January. Wow, that's amazing.
Yeah. It's the same old story that we've been saying for months, is just how surprised we are by the liquidity that this market is seeing.
I think it reinforces this, a real kind of amazing energy and jump in market stats, and we still haven't quite got through the pandemic yet. So let's have a look at the next slide, which is European weighted average cost of capital. And I was really pleased when LCD introduced this kind of measure, so that people just didn't concentrate on purely what the AAA pricing was, because of course, if you're a CLO manager putting together a CLO, it's what's your entire cost of debt, not just what you get on the CLO. And indeed, some CLO structures, I remember, came out a couple of years ago with AAAs that didn't beat the last one. But guess what? If you looked at this measure, their WACC was lower. So it was good. And then I just had a look at, let's have a look, our really good friends in Arium, Spire, 83 on their AAA. Wow, that's amazing.
Yeah. Yeah, I think, and we just wrote at LCD a news story that came out about 14 managers announced last week potential refis and resets, and then we counted at least 24 notices on Euronext Dublin in terms of deals that may possibly be reset or refinanced. So obviously, yeah, people are taking advantage of this pricing dynamic.
Yeah, and you know what? That again rhymes with exactly what's happening in my inbox. So last week it was full of requests for repricings and resets on CLOs. No new ones, all repricings and resets, quite a lot of them. Whereas in the preceding weeks it was a mix and match of some resets and some new CLOs. Now the market, the arranger's attention is clearly shifted to repricings and resets of existing CLOs. Because the market is so good. And with that weighted average cost of capital coming down, of course, rhymes with what we were saying earlier about that will have an effect on dragging loan pricing down.
Mm-hmm.
Okie dokie. Let's pop to the next slide, which is sources of funding, and again a quite dramatic continuation of the trend that we highlighted end of last year, beginning of this. The poor old loan market, getting battered when compared to the bond market.
Yeah, this slide just shows the shifting capital structures in terms of bond only transactions, senior debt plus bonds, senior plus mezzanine, senior only, and also senior plus second lien. Luke wrote a really good topical looking at senior secured bond pricing relative to loan pricing. And actually, we saw 6 deals already this year where the relative pricing was cheaper for the senior secured bonds than the loans. And you really can't see it in the averages all the time, but this is becoming more prevalent. And so I just wanted to show this slide to talk about that. I think that the reason that we're seeing that, which I'm sure is your next question, Chris, is because the investors in the bond market, they are investing relative to other asset classes. And so because of all this monetary stimulus, they're looking for yield, whereas CLO investors on the loan side, there is a natural floor in terms of what they will accept in terms of pricing because of the cost of their capital. So I think that's what's going on. I think the other key message from this is that although this is a trend, at the end of the day, sponsors still prefer loans in terms of being able to call the deals. So it is one of those things where we do see this from time to time, but and there's also a cost in terms of prepping the bonds, prepping an OM for selling the bonds. So there are some advantages where private equity will want to stick with a loan, regardless of the price savings.
And of course, I would say, yay, loans, way more flexible. But I guess a bond person would say, about time, loan world showing some pricing for the option that in the past has been free. But then if we think about the slide we've just seen about where CLO, weighted average cost of capital, is going, I'm sure that the way loan pricing is going, loans will come back more strongly if that trend continues.
Yeah. I mean, I also think it's also just interesting from the perspective of how in Europe, it was always sort of a loan market, but the market is so much more flexible now in terms of the financing opportunities available, in terms of, when things are difficult. Obviously, there's lots of liquidity now, but we did see this after the last crisis, is the senior secured bond market coming in to refinance deals when the loan market was shut.
Yeah, I mean, and there is that, again, to rhyme with what we said earlier, there's that very difficult dynamic that I'm certainly struggling with about inflation versus politicians saying they're not going to go back to austerity versus, people saying now's not the time to dampen down the economy, interest rates aren't going to go up, then people being worried about inflation. And of course, you don't want to go into fixed rate instruments if inflation is going to go up. And I mean, it's a real confusing picture at the moment as to where interest rates are going to go, where inflation is going to go, and therefore what instrument do you go into? To which, of course, I would say loans, because they're more flexible, wouldn't I? But it's still something quite difficult to think about. Okay, right. Let's just pop into the last two slides. So the slide about senior secured debt recoveries. I mean, I just wanted to put this slide in, particularly the right-hand graph, which shows that our expectations, certainly, of recoveries are relatively stable. They have nudged down a little bit from kind of like the upper 50s to the mid to upper 50s, but it hasn't changed that much. Don't forget, when we do a recovery rating, it's based on the company being sold on an ongoing viable basis. It doesn't reflect a fire sale of assets in a company being broken up. And then the last slide with some data in, which is first lien debt and in EMEA, what we rate and the distribution of ratings. And I guess for me, the point of this slide is how triple C's and single B minuses have stabilized. Q3, Q4, not that much, not huge amounts of difference in those bands. So that was interesting. I mean, if anything, some more B minuses than triple C's, but if you take them together as a band, they're kind of stable, which I thought was quite interesting. And then last but by no means least, Kung Hei Fa Choi.
Happy New Year.
Yeah, happy Chinese New Year, happy Lunar New Year. But by the time this will come out, we'll have passed the Chinese New Year, but we can still wish everybody a happy New Year.
Yeah, and Valentine's Day, although I guess that's a few days ago.
Yeah, no, of course. Yeah, I hope everybody had a happy Valentine's Day. And as ever, thank you very much, Taron. And if anybody has any questions, feel free to email or give us a call. Thank you.